All right, everyone. Hello, R2F here. In this video, I'm going to go through ICT's market maker models, his market maker sell model, and his market maker buy models. So I hope to put this in an easy to understand guide so that you can better utilize it for your trading using ICT's concepts. All right, so let's get started. What is ICT's market maker model? It refers to the way market makers operate to create liquidity and manage order flow in the marketplace. Now, I'm not going to go through all the technicalities of market making. That is not what this video is about. You can Google all of that information if you are interested in learning more. But I think what you want to know is how you can use ICT's market maker models to identify where price is going to go and, of course, capitalize on it. However, there are some core principles to understand first so that you understand why it exists in the first place and why it works the way it does. So the first thing market makers do is provide liquidity. They do this by being willing to buy and sell at quoted bid and ask prices. This helps ensure there's always a counterparty for a trade. So arguably the most crucial thing to understand is that liquidity is the lifeblood of the market. It's the most important concept, and it's something that is true. Okay, it's not a theory. Liquidity is basically orders in the marketplace. Okay, so you have things like order books, depth of market, footprint charts that kind of show where liquidity is. ICT himself, he doesn't use all of that because he doesn't believe those are reliable because they can be spoofed, as in orders can be faked as well. So trading is a zero-sum game, meaning that the net change in wealth is zero. Money is merely changing hands. If you wanted to buy, you would need someone to sell to you. And, if you wanted to sell, you would need someone to buy. All right, so there's no money being created out of nowhere. It's all a trade. So that's really important to remember because smart money entities have very deep pockets. The level of liquidity they require is a lot, basically. So to facilitate their entire positions, they can't get in and out like we can. We can do like a market buy. Easy. There's so much liquidity for us. But for them, it takes time and a little bit of some foolery. I'll illustrate this on the chart later in this video. Market efficiency paradigm. Simply put, the market seeks to be as efficient as possible. What this means is that price is offered a certain way so that smart money can facilitate their positions effectively. Because the market is efficient, it can be predictable. When something's predictable, there is opportunity. So, alright, so yes, the market moves efficiently. But for the uninformed retail crowd, sometimes it seems like all the market cares about is running, on their stop losses, right? If you've ever been in a trade and, as a beginner or as a novice, you may notice that price is always just going the opposite direction anytime you enter. This is because of the market makers. This is because of smart money. They know how the retail crowd thinks. Okay, they know the herd mentality and they know how to get them on the wrong side of the market. So if smart money wanted to buy, they would need people to sell to them. So this is where liquidity comes in, and it is how they move efficiently in the marketplace. AMD, accumulation, manipulation, distribution. AMD is another of ICT's concepts in which smart money accumulates their position, manipulates price to trap traders on the wrong side, and then push price and offload their positions at a higher or lower level of liquidity. So this is the same as ICT's power of three concept. This is happening on any and every time frame. Everything in price is fractal. Understanding what fractal means is important, so go ahead and Google that. It basically means what you see on one time frame or one size is what you see is the same thing that you couldn't possibly see on a higher or lower time frame. Okay, you see fractals in nature, in the universe. Many things in life is fractal. As mentioned, point one, smart money takes time and monkey business to facilitate their positions. They accumulate their positions, usually identified in areas of consolidation and they manipulate price, usually identified when you see a quick expansion in one direction and then a quick reversal in the other. Then they distribute their positions again at another key level of liquidity, also usually identified by another consolidation. It is fractal as well, meaning this is happening on the 1 minute time frame, the 15, the 4 hour, the daily, the weekly, and any time frame. It's happening all the time. They never look exactly the same, okay? So they're kind of like snowflakes or fingerprints. So, the market maker model diagrams that you see in ICT posts or other people post, they never look exactly the same like they do in the charts. They're always slightly different, okay? So you kind of have to be adaptable in that aspect. Let's go into the charts now. All right, here I have a market maker sell model. This diagram is by Lumi Traders. So in a market maker model, there's usually a consolidation, such as here. This is a sell model, by the way. For a buy model, just reverse the entire thing, and I'll show you a live example of a buy model. So there's usually a consolidation. You can call it an original consolidation, and then you find a price expanding out of that, price reaccumulating, price expanding, and there may be another reaccumulation here, and then it expands one more time, its final time, usually into a higher time frame PD array. Okay, so an area of liquidity either on a higher time frame or equal lows, equal highs, those types of areas where orders may be resting, which are usually at swing highs, swing lows. That's where people put their stops or their orders if they are breakout traders, okay? Equal lows because the common mentality is that people see double tops, double bottoms, or triple tops and bottoms. You see that as strength or resistance. But for smart money traders that use ICT concepts, those are areas of liquidity where price usually will be drawn to sooner or later, either to blast right through it or to take that liquidity and reverse again in its intended direction. So the area of liquidity, doesn't have to be the last stab up. It could be somewhere lower as well, and price can play around in there. So we get one more stabbed up. Price takes out the smaller term liquidity as well, and the higher time frame liquidity. It's either an inefficiency, and then we get the smart money reversal, SMR, which is a fast expansion, breaking the last, usually the last down candle before the up move. Okay, so you get a market structure shift, and then you get a retracement. The smart money reversal can be considered a turtle soup, which is a stab in liquidity. It's one of the most scary and I would say difficult entries to take, because price is just shooting up and you do not have that confirmation yet. So you have to be really confident in your analysis. But that can achieve the highest RR trades because you would have your stop at the top and price will just be able to go down to, let's say you were targeting the low here, the other end of the sell side curve, right? So that's one entry that can be taken. Another common entry taught in ICT's 2022 mentorship is the low risk sell. So you get a price coming into an area, higher time frame, premium PD array. You get a market structure shift. You see a fair value gap within that shift. You take that short. Okay, so a short could be taken in here, stop loss again above the high, and then you get another shift down, and then you get another distribution. This is the first stage of distribution, and you often get a consolidation, price coming up again into an order block, which could be this entire area, and then expansion down. So entries can be taken here in the order block at that turtle soup, or it can be taken once price displaces down and another fair value gap is created. And usually you get one more redistribution near the low and then an expansion. So price can still come up, take liquidity there as well. It doesn't have to create this equal highs. Again, this is just a crude diagram. So I'm going to delete this and let's go on the charts and have a look at a market maker model in action. I want you to pay attention to this area here. Okay, so price, this is a higher time frame. This is the daily chart. This is a 3-day busy. It's one of my, I've dubbed it the R2F gap. It's one of my high probability gaps that I've, I guess, discovered. Here it's on the 3-day. You can have a look on for yourself if you want on the British pound US dollar. But I'm just here on the 1-day chart. So we come here into a higher time frame liquidity. Price comes in and then it reverses from there, right? So let's go on a lower time frame so we can actually see the market model in there a bit more clearly. Again, this is happening on every time frame. This entire daily chart could be a market maker model. Out of a bigger picture, you can see market maker models on the 1 minute within the same thing. So price is fractal. If this was a 4-hour chart, you could see the same thing on a 1 minute. If this was a monthly chart, you could see the same thing on the daily within here. Okay, so let's zoom in on the 15-minute. I have everything annotated. So again, on the daily, we saw price come into here. So there's a consolidation here. You can call it the original consolidation if you want. It doesn't matter. It's not important. But you see a consolidation, price expand and displaced deep into this level of liquidity. Okay, so what's happening here? Price consolidating, price is dropping fast. And what are people thinking at this point? They're thinking, I want to go short, the price is going there, I don't want to miss the move. The British pound is going a lot lower. So this is the final leg. In Wyckoff, they call it the spring. It's the final, you would say, manipulation. Okay, but this entire thing is a market maker model. Here is the last shift down on the 15-minute. Small area of liquidity. This is the final step, and then the reversal. So in here, the smart money reversal. You know, if you go down to a lower time frame, you might see some equal lows here. This is the final one. And then some traders may take positions in here. Again, this is the turtle soup. You got to imagine at this point, you're just watching all the down candles and you're just trying to catch the bottom here. If you wanted more confirmation, you can wait for the low risk sell, which is up here. You get the market structure shift, the retracement into the gap. This is ICT's 2022 model that he teaches, but basically it's the low risk sell and you can get into a long here. So if you didn't get into a long somewhere in here, and maybe you're targeting the original consolidation or higher, all right, depending on your analysis, you could get one in here at the gap. You can put your stop at the low or at the bottom of the gap, up to you, up to your strategy. Again, this is the concept of how the markets move. It's not a strategy. Strategy is something you should come up with yourself, or if you want to follow someone else, go ahead. But this is basically the concept. So the RR is lower. In this case, if your target was here compared to, if your entry was here and target was there compared to your entry here and target in the same place. Expand again, you get another consolidation. This is the first stage of distribution. Okay, the first stage of distribution is ICT's favorite entry in the market maker models. Doesn't mean it's the best or anything like that. There's no best out there. It all depends on you, your personality, your experience with whatever you're seeing, what your eye gets drawn to quickly, right? So you don't actually need to understand all this market maker stuff. There may be other things your eyes recognize. And as long as you can manage yourself and manage your trades and risks effectively, you don't need anything else. We get that first stage distribution, the consolidation, equal lows. Price comes down, and again, manipulation, right? People are seeing the price coming down, they're trying to go short. You can catch an entry in there or inside this gap if you like gaps, or again, the shift in market structure and the retracement, either in here or in here. And you get another second stage redistribution, causes entries there in the order block. And then you get more redistribution in the form of accumulating more buy orders, and you see price continue higher from there into a larger consolidation. So that's a market maker buy model. If I flip the chart around, this would be a sell model. So price consolidating, coming to a higher time frame PD array, smart money reversal, low risk sell, first stage redistribution, second stage redistribution, and just more distribution and accumulation. So these are all happening on, like I said, on multiple time frames. As a trader, you got to be flexible, and you've got to be able to have a top-down analysis, I believe, if you want to use a market maker model. If you want to be correct about your analysis more times than not, you'll need to apply a top-down analysis approach. I have some videos on that, but it's basically doing analysis on a higher time frame and that having the stronger bias and priority in where you want to take your trades. So that's it for this video. I hope you found it insightful. If you'd like to learn more, if you need any help, feel free to get in touch with me through social media or TradingView. Till next time, R2F signing out.